This is my opportunity to welcome all of you that are with us today. I'm Steve Larson of the Hoard Dairyman staff here. We're very pleased to have you all with us today, and pleased to have as our presenter today Gary Sipiorski. He's a Hoard Dairyman Money Matters columnist and very experienced in banking and financial advising affairs. And the webinar today is brought to us by the Danisco Animal Nutrition part of DuPont Company, and we appreciate their support very much. And with those comments, I'll have our co-host Mike Hutchins take over and further introduce Gary Sipiorski, the presenter today, and go from there. Thank you, Mike.
Very good, Steve. Well, thank you very much. It's really an honor, pleasure to introduce a good friend and colleague, Gary Sipiorski here. He and I both grew up in Brown County. Actually, he is in the Denmark area, and he has spent 17 years with the Citizens Bank of Loyola, ending up as president and CEO and director of the board of directors. Previous to that, he spent 18 years with the Ralston Purina Company, and so he's got some interesting experience on that aspect as well. Then he also serves as a national director of the Independent Community Bankers of America and chairs the National Ag Committee. Then he also has been very active at the University of Wisconsin, and in 2008 he was asked to be on the advisory council for agriculture, industry, and labor for the Federal Reserve Bank of Chicago. So obviously ample opportunities to be exposed to this whole area of finance. Then in 2008 he was decided to join the VitaPlus Corporation, and certainly has been very active there. And Gary, we see you all around the world actually covering topics like this. So Gary, it's my pleasure to invite you to take over and conduct today's webinar on a farm financial business checkup.
Okay, thanks, Mike. I'm going to tell everybody to fasten your seatbelts. We've got a very interesting session. We're going to have some fun with this. You know, numbers can be kind of boring at times, and people say, oh, and they yawn and everything else. Well, I'm going to put a little extra twist on this, and I've put it with a medical theme to it. And I've had our good friend here, Jim, here that's put this thing together for us as well. And he's put some really interesting slides in this. I'm also going to ask you to get your pen and pencil ready, because you're not going to be able to copy all this information, but I encourage you to get your action list. Take 3 items of the 15 that I'm going to be talking about, and I want you to take a look at your financials and say, I wonder how I'm doing on this. But it's real important to know your numbers today, folks. Back in the late 70s and early 80s, our expense rate on dairies was 50%. Just go back and talk to dads and grandpas about that and others, and you'll find out that the milk support price was at $13.50. Cost of production, believe it or not, was $6. And boy, that has changed, because now today we're looking at an 85% expense rate. But you got to have that balance sheet, and these are the numbers that are important. You've got to have that balance sheet in the back of your head, and you've got to think about that cash flow, because every day you make decisions on that cash flow, it goes right to that balance, back to that balance sheet. Now, I'm going to say something so I don't get in trouble. And it used to be you took care of your cows and your crops and you were successful. You still have to work hard. All right? Everybody got that? So I don't get in trouble on that comment. But today you got to think smart as well. It's not only taking care of the cows and crops, but you got to think about what's going on. Take these 15 points that we're going to present here, and I know you get a chance to go back and review them. And you're going to impress your lender. You'll come in on an annual review and say, okay, I've got 15 points I want to discuss with you, lender. And by the way, if you don't have a lender, congratulations. You've already got these points figured out, and you're successful in what you're doing. All right, let's get rolling. 15-point checkup. First one, poll question we're going to start with. Who's the most important person that needs to know the numbers? Is it the bookkeeper, the accountant, the lender, or the owner? So Mike and Jim are going to take and open that poll up, and let's get that rolling. And you guys let me know just when the poll numbers come to the point where we can show the results.
Okay, very good. Well, Gary, the polls are open, and so far, I don't see anybody voting.
Have you picked your favorite?
I've got mine picked out, but we'll see if I win or lose at this point.
I might bet a piece of pie on it, but I wouldn't bet a pie a la mode on it.
Don't you hate these? Don't you hate these teachers that give this multiple choice and it should be
Yeah.
so easy, but it's not.
Wow, we must
Well, we're
have
voting
a lot
fast
of
today.
we got a lot of Republicans or Democrats because we got 2/3 the vote in and 49 seconds. Jim, let's go ahead and close it. I'm not sure. I'm with the majority at this point. Can you see this, Gary?
No, I can't see it, but go ahead and share.
Okay, the owner is 97%, the bookkeeper's 3%, and the other two didn't get a vote. So, what do you think?
All right, and that's exactly where it should be. It's the owner that's need to know this stuff. And granted, the bookkeeper that puts this stuff together needs to know what's going on. Yes, the account needs to have good numbers, and I'll tell you, your lender is going to want to know. But absolutely, the owner has got to know just where these numbers are and where they fall into place. Okay, let's move on. All right, first question the doctor might ask you, you're sleeping at night. Ownership equity, this is key. 50% is okay. 30% is the minimum. If you're beyond less than 30% equity position, it's really going to be difficult to take and get anything done with a lender and borrow any more money for any particular reason. I always have to put this because people say, well, Gary, is more or less better? Well, in this case, more is better. More equity certainly is better. And it's a simple formula. You just take your net worth and divide it by the total assets. And I've used a simple example here. Take $400,000 of net worth and divide it by $1 million of assets. And by the way, that doesn't buy you much of a farm today with the kind of numbers that we have and the zeros behind the numbers. That's a 40% equity position. But absolutely, you got to know this. You need to sit down before you go out on New Year's Eve, do your balance sheet, and make sure that that balance sheet is growing every year. All right, second question. How's your back? Roll over, the doctor might say. Talking about asset turnover. In 2.5 years, you ought to be able to turn all your assets. Now, the average turnover is anywhere from 3.5 to 4 years. Another example, I've got $1 million farm, and I'm generating $400,000 in gross income now. So if you do that simple division, that comes out to 2.5 years. Now, the question is, golly, Gary, if it takes 4 years, what's going on with some of these places? Well, does anybody hear the word high land value? Because if you plug in some high land value into the value of the farm, you're going to find those assets are turning a lot slower. So either we got one or two problems. Either we've got too many assets out there that are not generating enough income, or we're not generating enough income. But take a look. How long does it take you to turn your assets, and how many years? All right, let's go to the next one. Doctor might say, how's your appetite? Looking at current equity, and this is really key, and this is becoming more of a concern. Basically, we come through the last 5 years in the dairy business, other than '09, and we all know how much of a disaster that was. And liquidity has not been much of a problem because banks and lenders in general, the farm credit system has just been flush with money, and they're really willing to give it to producers that have a decent balance sheet. Key. You need to have $2 of current assets for every dollar of current liability. Now let's just take a look how that comes out. This is the upper portion of your balance sheet looking at the current assets. Those are cash, savings, receivables, money that people owe you. Maybe you sold some crops and people owe you some money. This is all the feed that you have on inventory. Any marketing animals you might have, steers, crops, and there ought to be $2 there. Compared to the other side of the balance sheet, the upper portion that we call current liabilities. These are payables over 30 days. These are past due rents, maybe past due taxes, and some of you might say, well, that's nuts. Anybody got past due taxes? Believe me, I see it. It's out there. After 3 years, be careful. The county wants to sell your farm. Hopefully you don't have many folks that are listening that are having that problem. Principal due in the next 12 months, not interest, just the principal. Interest is a part of the cash flow. Principal obviously has to be paid with cash flow, but that's part of that current liability. So you need to have $2 for every dollar here in current liabilities. Absolutely key, and I think lenders are going to become more and more a stickler on this particular situation. I might give you some benefit, maybe have $1.50 over here in current liabilities to $1 of current liability. But be careful. I really like to see that 2-to-1 exchange. Other considerations. If you've got payables out there, and lenders right now with lines of credit are probably at 4 to 6% interest. If you owe the vet or the feed company that you're dealing with, or the fertilizer, or any cropping, and they're charging you 18%, I think you really need to take a hard look at that, because interest rates at your lender is going to be a lot less than that 18%. You need to get those things cleaned out. The other thing, and I've been talking about this for 5 years, ever since interest rates have gone down, and yes, I know that they've still stayed the same. In fact, the Fed is continuing to keep interest rates where they are. That's another whole webinar, but we won't go there. But think about fixing those interest rates, because we have got absolutely historical low rates, and now is a great time to take that unknown out of the formula. All right, let's go to poll question number 2. We talk about the return on those assets on a dairy farm. What do you think the average has been historically for dairy producers? And if you're paying attention, you already know that answer. But let's just do the poll and see how well our class is doing, Mike, shall we?
Yeah, let's do that. But the polls are open right now, and we're off and voting now. Steve, have you got your favorite one picked out?
I do, and this is very interesting. I had a tour of people, actually international journalists, not ag journalists, but international journalists at the farm just Saturday morning, and they asked me what is a good return on investment on U.S. dairy farms. So I gave them my answer, and we'll see if I was in the ballpark on that.
Okay, Steve. Now let's fess up here on what's your answer, because we're going to close this off in a second. What was yours?
Well, mine was about 4 actually.
I'd pick 6, but we'll see what the official has to say here. Let's we've got two-thirds are in. Gary, write these numbers down. We've got 2%, 12% that said 2% return. 46 have Steve's answer. 32% has my answer, which is 6%. 10% said 8%. So it's 12, 46, 32, 10. What do you think, boss?
All right, now this is good, because Steve, we're going to talk about return on equity in a few minutes along with return on assets. But the majority is right, Mike. I'd like your number at 6%, but historically that's not the way it's been, because we haven't seen that. Now let's just take a look at this. What's your weight when we look at the return on investment? And it is the 4% is what we've seen on average. Now let's think about the investment per cow we have out here. Now I'm talking about everything. Facilities, cattle, machinery, land, the whole ball of wax. Target would be $15,000 invested per cow. Think about that. That's a lot of bucks out there on a per cow basis, and I can see that spread as I look at herds anywhere from 10 to 20,000. These would be herds that are more the Western style, that don't have a big land base. These would be those that have a land base at a 20,000. But the return on assets should be at 8%, and it's just simply looking at the net. Now this is without interest. Now I'm going to make a quick comment here, and you can argue with the people at the Farm Financial Standards Council or the General Accepted Accounting Principle. In fact, David Cole sat on the Farm Financial Standard Council, and what they do when they figure return on assets, pay attention to this, is without interest as the expense. And that's because they want to take all businesses, and particularly farms, and put them on an equal basis whether or not they got money borrowed. All right? Now, it may not seem right, but that's the way it's done. And boy, I would like to see an 8%, and we're only seeing half of that at a 4%. Here's my example. I've got $80,000 of net income. This is net after the producers paid themselves even. With a $1 million farm, that's a 0.08 or 8%. Now, Steve, going back to the comment that you had this weekend, return on the equity, and this is just looking at the net worth. Now we throw interest in there. All right. Again, you can argue with the David Coles of this world if you don't like that, but that's the way they do it. But look at your net income divided by the equity, and you would think this number would be bigger, but because we throw the interest in there, I'm satisfied with a 6% there. So, Mike, you would have been right if I would have asked a question on return on equity. But there's the key numbers. You ought to see at least an 8% return on your assets and a 6% on your equity. And frankly, folks, I have seen people blow that number out of the water. And kudos to them that have done it. All right, let's move on. Have you lost any weight lately? Debt per cow. And boy, this can really be a contentious question right here. Most lenders you'll find at $3,000 to $5,000 is okay. I've seen that number go to $7,000. And if you got the right terms, you take these loans and stretch them out to 40 years. And I always ask people, you know how old you're going to be in 40 years if you stretch a loan out that way? but what it does help with the cash flow. If you have more debt than that, it does get tougher to serve. Another way to look at that is point number 6. Have you gained any weight lately? And this is debt coverage. You can't spend more than 15% of your milk check on interest and principal. So if you just look at your payments on an annual basis, divide it by the gross income, you can't spend more than 15%. Maximum would be 20. But I like to keep it at 15 because if we have an 09 show up again, heaven forbid, I may have to push that to 20%. The other thing we need to look at is debt per 100 pounds of milk. A little different way to do it. Obviously, the pounds of milk you're generating, you ought to be able to service some additional debt. And for every dollar of debt, you should have, a dollar of debt, you should have $20 per dollar of debt. $20 of debt per 100 pounds of milk. Let's put it that way. I don't get too confused here. So $20 of debt per 100 pounds of milk. And that's another key factor that a lot of lenders will take a look at. All right, next question. Are you getting enough exercise, a doctor might say? And this is looking at the net income or the gross income that you have first. And you ought to be able to generate at least $5,000 a cow. Now, I'm looking strictly at a dairy operation. I'm talking about milk, cull cows, and also bull calves and whatever they are selling for that year. But $5,000 should be the number that you really should be looking at. All right, take a look at this, and this comes from Dairy Business, and I thought this was a very interesting chart, so I threw it in here. This is 2005 and compared to 2013, and these bars represent the cash receipts from dairy. This is the cash receipts that dairy farmers receive. Now, back here in 2005, we were at $25 billion, and that's with a B. Now, here's this historical 2009. We actually dropped under $25 billion. This year now, we are anticipating just about $40 billion in gross receipts on dairy. Anybody think there's money in this dairy industry? Obviously, you got to be able to produce this kind of income with less expenses. Should be a no-brainer. Okay, point number 8. Let's check your heart. Milk sold per cow. Now, we're going to talk colored breeds and Holsteins here, but you ought to be able to at least do 24,000 pounds with a Holstein. I mean, we've had a tremendous increase in production after World War II. You know, the average production was only about $5,000 a cow, but with genetics and people like Mike Hutchins that showed people how to feed cows better, and many other good folks out there, and people like Hoards that have had a lot of good articles in there, we really kicked those Holsteins up. But pay attention, folks. By 2020, USDA says the average cow is going to be producing 25,500 pounds of milk. Now, here's where I got to be careful. When I was preparing these charts, I'd gotten questions about, well, let's talk about some colored breeds. So I'm just going to spend just a little bit of time on this. And I know we've got Jersey breeders listening. You ought to be at least 17,000 pounds. My information from other types of Jersey breeders, I mean, anywhere from 14 to 20,000 pounds. Some of the coloreds, I'm talking Ayrshires and milking Shorthorns, just a little bit different. People ask me all the time, Gary, what's the most profitable size herd, the most profitable type of dairy animal? My question is, and I don't want to be a smart aleck about it, but it's the one that makes money. All right? I don't care what color you want to do, where you want to go, but let's face it, better than 95% of the cows in the country are black and white, and that's for a reason. All right, so if production and income is lower, that cost of production ought to be lower as well. We've got to have something left over. Now, let's just look at a couple of numbers here quick. This is from the summary of 3 Midwest accounting firms. And this is mostly Holstein cows that we're looking at. And it was interesting when I put this together. This is the average, this is the lower group, and this is the top group. And anywhere from 22 to 30,000 pounds of milk. In fact, I was on a herd the other day, and the producer was kicking out 34,000 pounds of milk. Here's the cost of production, these different levels. The average, here's the lower one, here's the top one. Actually, the top one had lower cost. And there again, that's another great webinar we can get into. Total income. This is the 100 pounds of milk. And this is 2013, and this is only through the month of June. Of course, it takes a while to get these numbers together. And here's the net that these producers are bringing in. $1.92, $2.30 on the average. And here these folks are looking at $3.49. Now, if you don't think that's a big deal, take $1.100 and multiply it out times the number of cows. And this becomes some real money. Let's take a look at a couple other things. These were the questions. How about some other ways of milking cows, Gary? Organic and grazing. Now, I'm going to just tell you, Tom Kriegel at the University of Wisconsin, the Center for Dairy Profitability, has got reams and reams of information on organic and grazing and the conventional way of milking cows. So if you want to download some of his stuff, you can look at where it is. But I'm just looking at some averages here, some observations I've seen. It's hard to get some of these numbers. Tom has done a nice job with the numbers. The organic people usually run a higher cost of production, and their gross is going to be higher because they get paid for the milk. In fact, that's one of the only areas we're seeing an increase in fluid sales, believe it or not. The grazers, obviously low input, and their cost is going to be similar to what a conventional herd is, and you can see the kind of nets that you have here. So these things are going to be all over the board. The reason that I bring these up, I don't want to get anybody's fur ruffled in the wrong direction. I simply want to challenge you to figure out what your cost of production is. I don't care how you do it. I don't care what color breed you have. Make sure that you got some net left over at the end of the year. All right, this goes back to one of the statements that I just made. This is a USDA. Even though they took a couple weeks off, they did put a chart out here. And again, this is Dairy Business that had this particular one. Now, we actually have about 9.2 million cows right now. So they're 2013. They actually are projecting a little less cows. We're not to the end of the year, and we'll see where that goes. Now, these are the purple bars, so just follow with me. These are cow numbers all the way up to 2022, anticipating about 8.9 million cows. So we're going to lose some cows here, maybe 300,000 cows overall, nationwide. This is U.S. Now, the blue mark here, this is the production, milk production. We're at 200 billion pounds of milk, just over that right now we're producing. Looking at 230 billion pounds. Exports have absolutely exploded, and we've got a lot of positive things coming from that. But if you take and do the math on that, right back here, this is 21,700 pounds of milk that we're kicking out this year per cow. If you do the math on this, this is 25,800 pounds of milk. So you can see, if you're going to be in this business, continue to do a better job. The breeding gets better all around. We're going to have to just do a better job with those cows, and we know it's going to continue to grow. That's why we're in this business. Now, question is, have you had any operations lately, the doctor might ask you. Now we're talking about operation costs. I just said back in the late 70s, we were looking at an operation, total cost of operation of about 50%. And it's hard to believe, but take a look at when the blue silos were built in this country, and that's when people had half their milk check left over. Yeah, I know, as you got into the 80s, we had some escalating interest rates, and that was a nightmare in itself. But basically today we have an 80% operation cost. I don't want that total cost being any more than 85%. Now, I see anywhere from 65 to over 85%, unfortunately. And what am I including in that? All operation costs. I am including interest and depreciation and family living. I know a lot of people, you ask them, well, what does the farm pay you? And they say, well, I get what's left over. Baloney. You really need to factor in what you are getting off that farm. You are being paid to manage that operation, and you ought to have something left over when the year's end. So this is the operation cost. Now, let's go to another poll question. All right. When should a dairy producer do budgeting for the next year? October of the present year, December, maybe January or March of the budgeting year. So, Mike, let's open it up to see what people have to say.
Wow, Steve, this is a tough one, guy. Holy smokers! Well, I think we should have went back to the first question. That was a slam dunker. I tell you, they're getting tougher and tougher, Gary. We're off and running. Steve, are you going to vote on this one?
Well, I tell you what, this is an interesting question because our company has a June 1 fiscal year, and so for the Hoard Dairyman farm, we budget in April and May. So I have to disqualify myself. It doesn't apply.
Why are you disqualified?
Well, just back it up. even if you've got a fiscal year, just back it up a few months. So back it up 3 months in this case.
Okay, in that case, I have a favorite.
And that would be which one?
It would be October.
I'm going to vote for October as well. I'm not sure if it's right or not. Anyway, we
quite a few other
gotta
people
cut this
are.
off. We got 2/3 of the vote in again. Gary, here are your numbers for October of this year: 60%. December of this year: 26%. January: 9%. March: 4%. I think those are the Tea Party people.
All right, I tell you what, I'm really impressed with the answers we're getting here from the poll questions, because the majority has been correct, and it really should have been in October when you're doing this budgeting before the year. And now you say, "Well, thanks a lot, Saporsky. This is November, and now you give me this trick question and tell me I should have done it last month." All right, you need to do it. Bottom line, and some people say, that what am I budgeting for? It's going to be wrong, and I'll tell you it's going to be wrong by the time the year ends, because where's milk prices going to be? All right, where are the expenses going to be? We don't know exactly, but you know what? You still need to do it. General Eisenhower had a very interesting statement. He said he would never go into battle without a battle plan. But he also said by the time the battle was over, it never looked like the plan. Now, the point being is that you need to sit down if you've got managers on your operation, or if you're a family operation, sit down and pencil out where you think your expenses are going to be for this next year. Where do you anticipate your income? And that'll help you think through, do we buy stuff? Do we don't buy stuff? Do we expand? Do we add 50 cows? Do we add 100? All of these decisions. And at the next year, when you look at that budget, compare, now hopefully you review that thing on a quarterly basis. How close did you get? Were you 10% away? I think that would be really good if you were that. But you really need to sit down and do that. And I know there's a lot of things that go on in October on a dairy. But September's okay too, to start some of this stuff ahead of time. But just think about what's going on with the current year's income and expenses. And are you reading? Are you looking at what's going on? Do you see what's happening in the dairy world? Do you see the opportunities that are out there? Do you see some concerns that are out there? This is what you need to be budgeting. But I'm impressed. I'm really glad to see that 60% understand that they need to do this ahead of time. All right, number 10. Are you eating good and healthy food? Well, let's talk about feed costs. This is absolutely one of the biggest items on most of the expenses. Now, you say, well, Saporsky, you look like a real economist here with a 20 to 45% spread here. That should be pretty easy to be right on. Well, let's talk about why I say this. If you are a producer and you have a big land base, you grow all your forage, grow all your grain, you're probably going to be 20%. And if you are Western-style dairy producers, where you just have a limited amount of land and just milking cows and buying all your feed, you'll be at 40%. In fact, sadly, this last year, with the high prices that we've had, some of those Western producers have been as high as 55 and 60%. And boy, I tell you what, there isn't much left over when you're doing that. So you really need to look at your operation. The more products that you raise on your own. Now, you're going to have a little higher expense because you're going to have probably some extra equipment around, some extra cropping cost if you're going to be raising a lot of your own feed versus people like this. Boy, I tell you what, in the past, this Western style for about 30 years was almost a license to print money with $2 corn, and hay was selling for $80 a ton. We all know that it appears some of those days have gone away, although we're looking this morning, I see corn was at $4.36, so we'll just see where we go from there. But simple way to calculate that, take the total feed cost divided by the total income, and that tells you just exactly what you're spending on feed to feed those dairy cows. All right, are you eating your vegetables? This goes right along with it. And this is looking at cropping cost. With a dairy cow, we're probably looking at about 3.5 acres per cow. Now pull your pencil out and just write this down. Generally, it takes 1.5 acres, 1.5 acres to raise the forage for a dairy cow. All right. It takes about 3/4 of an acre, 0.75, if you're going to grow the corn or the grain that you're going to feed your dairy herd. And then another 3/4 or 0.75 acres in order to raise enough forage for your young stock. All right, so if you add all that up, it actually comes to 3. So I'm going to be a conservative banker here, and I'm going to say you need to have 3.5. Now, the people where Dr. Hutchins are in that area, they're in Illinois, beautiful prairie soil, probably can get by on a 2.5, maybe 2.8 acres per cow. Depends how what the productivity of the land is. You get above a Highway 29 in Wisconsin, and you're probably going to be needing some more acres. But that cropping cost shouldn't run any more than 4% of your gross income. Remember, there's an important nutrient. W.D. Hoard said this over 100 years ago. One reason that he encouraged dairy cows was to get those nutrients out of the back end of that cow. Now, let's not take that manure lightly, because that really adds to a tremendous amount of organic matter. Maximum crop cost should run more than 8%. And again, are you figuring this? Are you enterprising that out? When I'm talking cropping cost, I'm talking fertilizer, I'm talking seed, and I'm talking chemicals, just those items. I'm taking the fuel out of it and rental cost and things like that. I'm just looking at those items, but figure out what it is. And frankly, I've seen people with cash flows that will running as high as 12% on some of this crop costs. And what in the world are you folks doing? Now remember, this is strictly to feed your cows. If you're raising a couple hundred acres to sell as grain, don't charge the dairy cows for that. You got to take that out of there. Be careful what you do. But I have seen people just trying to feed cows on 12%. That don't work, folks. All right, let's check your lungs. Let's talk about heifer raising. Boy, it used to be, some of us remember, and I mean, people like Mike and I have been in this business over 40 years, and we remember calves being tied between the cows in some cases, or tied over by the wall of the barn wall. And a lot of those days are no longer with us. But heifer costs used to be, well, whatever was left over from the cows. But we've got anywhere between $1,700 and $2,000 to raise a heifer 24 months. Now, Dr. Hutchins shared this with me right before we went on air online here, and I'm going to share this because not enough people think about the impact that raising heifers. And very quickly, if we look at the feed cost running over $1,000 here, if you figure everything, it's not free. Here's labor. A lot of people say, my labor is free. Baloney. You ought to pay yourself something for it. $333. Variable cost of taking care of that animal, and fixed cost, the facility cost, looking at $1,862. Well, wow, how about that? Comes right between my numbers, Mike. And that's added value calf cost of $363. This is information that was picked up by Dr. Hutchins from a University of Wisconsin meeting that he was at recently. Looking back, 1999 all the way to 2013, look at the total cost. I mean, we can see where that huge impact was in feed cost here. Anywhere from less than $1,100, $1,323. Now, again, looking at that $1,863. Daily cost, and these are days on feed, so they've come down a little bit. We keep getting those heifers freshening a little sooner. Here's the other thing that, and I know a lot of people probably listening have somebody else raising their heifers. This might be a good chart to take a look at, and that these different weight limits, age or weight groups, and different age as far as months goes, this is the cost that University of Wisconsin has come up with that it costs to feed that animal. Of course, as that animal gets bigger, they eat a whole lot more forage and some grain anyway, and there's some additional cost with that. So if you look on a daily basis, you may want to take a look at this if you're raising heifers for someone, or you got somebody else raising your heifers. So good information. Thanks, Mike, for that. All right, next question is, do you get any headaches? All right, this is perfect, and Jim has done a nice job of putting some graphics in there. Labor cost. This is where some dairy producers have now made a decision to go with robotic milkers. Boy, I tell you what, another session, Steve, that you can take a look at. A great webinar. Pretty costly when you take a look at that type of stuff, but eliminating the labor cost or much of it. Shouldn't have to spend any more than 16% of the milk check for total labor, and that includes the family living. All right, and that's going to equate out to anywhere for $1.80 to $2.50 per hundredweight for just the hired labor. And if you add in the total family labor in that, pay yourself well, that's going to be about $3.50. A lot of times we get Western information out of Nitsky Volt, the people on the West Coast, the accounting firms out there. There's two major accounting firms. But you'll see about $1.80, $1.50 a cost of labor, and that's because they usually don't put in the owner's return out there. So that's we got to be careful on that when we're comparing that. But here again, looking at a cost per hundredweight, just exactly what does it cost you from a labor standpoint. And again, your time, your management, your skills are worth something, so you ought to be able to take and pay yourself. All right, next one. Do you have any joint pains? The doctor might say. I'm talking about livestock costs. These are veterinarian and breeding expenses as a percent of the gross income. You might say 4%, Saporsky. Come on, that's such a tiny number. Why are you even talking about that number? Well, I tell you what. You know where a lot of these, and I'm pull your BST out here, by the way. If you're using Posilac, pull it out of this number because that's going to distort this number. I'm just talking about vet and breeding. A lot of problems the dairy producers know, and those that are listening, come plus or minus 30 days of calving, don't they? These are what we call metabolic problems. These are the milk fevers, the ketoses, and so on and so forth come in. If this number starts to grow, and we're seeing this grow to 6%, 7%, 8%, well, that ought to alert us that maybe something's not going on right. Where are we spending this additional money? Now, veterinarians like to stay busy, but most of them are now on a health-conscious kick where they want to help producer avoid these problems. So just take a look at where this number is, because if that cow gets out of the blocks and she's healthy and ready to go and she doesn't have any of these metabolic problems, we know she's going to produce 2,000, 3,000, 4,000 pounds, even more pounds of milk, let alone survivability if it's a severe problem. So just monitor that, see where it goes. And guess what? We are now up to the 15th question that the lender is going to ask, or the doctor will ask, and that is, what's that cost of production? What should it be? Again, looking at a lot of our black and whites running in that $17.50 range. I have seen herds that have run in the $16, and I'm talking about numbers this year thus far that we've been able to accumulate through 3/4 of the year, even $16 a hundred. These are herds that have pretty good land base, raising a lot of their own stuff, very efficient facilities, heifer facilities set up that it takes a minimum time to feed them and take care of them. And unfortunately, I'm seeing these numbers run over 20%. Now, obviously, if we get paid $20 a hundred for milk and it costs us $22 a hundred to produce it, it doesn't take a real economist to figure that that isn't going to work very well. But now there's a couple ways to look at these expenses. A real easy way to take and look at your cost of production, and be careful with this because I'm talking the tax return now. Taxes returns are done to keep the IRS happy because, of course, in the dairy business, agriculture in general, it's cash business. We can do prepaids, can't we? If we have bills that we owe, they don't show up in the taxes because we haven't paid them. But if you take a look at your Schedule F on your taxes and divide that by the 100 pounds of milk, that's going to give you a ballpark figure. But be careful. If you have prepaid a whole bunch of expenses in 2013 for 2014 and you divide it by the milk that you produced in 2013, oops, it looks like we got a real high cost of production. But what'd you do? You prepaid those feed costs or fertilizer or other types of things, and you charged cows in 2013 for stuff that's not going to be spent until 2014. So be careful with that. Now, there's a couple ways to look at the expenses, and if we use taxes, we're going to be looking at the depreciation. You're going to have to add your family living in there because the IRS thinks your family living is profit. So they're not going to include that as an expense. Although if you're a corporation, I realize you can take and put some additional things like groceries and other things in there. But if you divide that out, that'll give you a pretty good cost of production. Now, the other way to look at that is to take your expenses, take the principal. Now, here again, what does the IRS think principal is? Profit. So that's not deductible. Yeah, well, wait a minute, Gary. The lender that I have, they take a monthly milk assignment and principal and interest comes out of that. Well, that's true, but again, principal is not deductible. And take family living. So we got two things going on here. This is what I would call checkbook expenses, cost of production, because these are expenses that come out that you have to pay This is principal that has to be paid. This is family living that, whether you keep track of it or not, comes out of the checkbook. That's really what it's costing you to run that dairy. That's what I call a true cash flow. If we do it this way, just simply using depreciation and not principal, okay, that gives you a cost of production. But there isn't anybody that takes this depreciation charge on the Schedule F, and theoretically, what should you be doing with that? It's a deduction the IRS gives you. You ought to be putting that money in the bank and saving it for that next tractor you're going to buy. That's a joke, isn't it? How many people actually put money away for that next piece of equipment based on the amount of depreciation? That just depreciation comes off the gross income. That's why dairy producers, agriculture in general, wants to maximize that depreciation, because that takes it off of the gross income. Ever hear the term living on your depreciation? That means somebody takes their maximum discounts in depreciation and they still don't have any money left over. Well, that's because they're taking that depreciation money and they're living on it. So be careful with that. So my challenge to you is, what is your cost of production? Do you know? You need to know where that is, particularly where expenses are as high as they are today. Okay, with that, let me just close with this particular chart, and I thought this was pretty interesting. This is looking at the, this is as of June of 2013. This is all milk price over feed cost. Now, this is just feed cost. This is not total cost. But just follow with me on these bars here. This is a national. This is looking at the first quarter of 12, first and second quarter of 12, second and fourth quarter of 12, first 3 months of 13, next 3 months. This is through July of 13. Here's the national average. This is what we've got left over after we pay the feed cost. All right, you see where these blue numbers are going, or blue dials are going? Here's green, California. Now you see why the folks out in California are always screaming about their milk price. They're running about $2 higher feed cost and about $1.50 lower milk cost, so it really shows in their income over feed cost. Now that's changing now with some of the prices we have. Here's Wisconsin. Let's just call this Midwest so we don't get too confused and just point to Wisconsin in general. But let's look at Midwest. You see, that's why the Midwest, this is some pretty good land bases that these producers have. Here's New York. I mean, you want to pick a great place to produce milk? Well, it looks like New York is really a great place, particularly with those new yogurt plants they've got out there. And then the last one, the purple one, is Idaho. And I've been out there, and those folks I consider real scrappers. They try to get by on a limited amount of facility, and they just try to produce as much milk as they can. But you can see again where their profitability is. But you can see some real advantages here to the Midwest and the East. All right, so what we want to do, final comments here, is we got to keep Dr. Lender comfortable, don't we? Again, if you don't have a lender, hats off to you. You've already got all these 15 points figured out because you are your own banker. But you got to know your numbers. Absolutely important. Green runs in the bloodstream of a dairy. Now, if it's red, now hopefully you got red in your bloodstream, but when it's red in a dairy, you know, that doesn't work very well. But green, that's profitability, that's cash. How about your retirement? This is something a lot of people don't think about that. And sadly, I've seen people go through 20 and 30 years of milking cows, and they never put anything away for retirement because my farm is my retirement, right? Well, I can tell you that there are dairies that I've been on, and I've been pleased to do business with them, and still have contacts and doing business with them that have some substantial dollars put away in 401ks and SEP programs and other types of retirement, and that is really neat to see. My last comment is how about that next generation? Dr. Hutchinson, I'll tell you, being in this industry for 40 years, boy, Mike, doesn't 40 years fly by? Goodness gracious, where did it go? But what are you thinking about? Are you making your farm profitable for your sons and daughters? How about your grandchildren? How about your legacy on that dairy? Are you making it profitable for them? And it's really a pleasure to see many of these farms making things profitable for that next generation, and that's really great to see. Okay, with that, gentlemen, those are my doctor checkup. We had a doctor checkup here in 45 minutes. How about that? We got through all the information. I've thrown a lot of stuff at you. I know this is recorded, so people can go back and look at it in the future. But you come in with these numbers to your lender, and after you pick your lender off the floor, they'll wonder what you've been listening to, because these are things lenders normally don't hear. But these are things that they want to hear, and these are things you should hear for the success of your dairy.
Well, Gary, excellent job. Steve, why don't we turn it back to you for the next couple PowerPoints?
Super. Gary, excellent job, and you did come in on time, and we appreciate it. Your Farm Financial Business Checkup was very well done, very well organized, well illustrated, too. Of course, you made it very interesting, and we appreciate your efforts very much. Nicely done. We also appreciate Danisco Animal Nutrition, part of DuPont Company, for their sponsorship of today's webinar. And as you see on the screens now, we want to turn ahead to your attention to our next webinar, December 9th, Growing High Yield and High Quality Corn Silage in the Northern Corn Belt. Joe Lauer, experienced extension agronomist at the University of Wisconsin, will make that presentation, sponsored by Kuhn North America. And also our thanks to Mike Hutchins, our co-host down there at the University of Illinois, and his sidekick Jim Baltz, who works with the illustrations and all the mechanics behind the survey software, and we appreciate your input as well. Just a comment here that as Gary just mentioned, this webinar and all of our previous webinars are available. Just go to the Hoard's Dairyman website, click on Hoard's Dairyman webinar series, and they're all archived there. Over the past, about a little over 2.5 years, we've had 29,000 archive views of past webinars. That's an average of about 30 a day, or over 800 a month. So people have been interested in it, and of course it's free and available anytime anybody wants to make use of it. And just one more note that Hoard's Dairyman now has a new free weekly newsletter called Hoard's Dairyman Intel. It has some articles, some video links, and some news that is not in the magazine. Just go to the home page, and you'll find information on how to subscribe to the Hoard's Dairyman Intel newsletter, which is a new effort of ours. Also, the listeners, glad to have you with us, and I just wanted to let you know that you can expect a survey of your evaluation of this webinar here sometime by the end of the week. So we appreciate your participation in that, so that we can keep our webinars timely and what it is that you folks want to hear about. Now, Mike and Gary, do we have some questions to discuss or some comments?
We sure do. Gary, can you click forward one more PowerPoint so we can, again, show our sponsorship? Let's go
Click
the other
forward.
one more.
This way?
There we go. Thanks, Gary.
Oh, wait a minute. Right there. You want to be.
Yep, that's where you want to be. Very good. And again,
appreciate those folks.
You betcha. Thanks to our sponsor. Without the sponsor, these programs could not be presented. We do have questions, so get ready. And we're off and running, and there's a few more coming in as well. One question was about the your point 11 in terms of raising the feed, and should you not be putting in the price, the market price versus the production price? What's your feeling on that? This person asks in terms of cost to raise the corn versus buying the corn.
Well, if you're raising corn, you really need to put your actual cost on that. I mean, right now, Dr. Mark Stevenson out of Madison says it costs $4.25 to raise a bushel of corn. You really need to figure out what your cost is, so that's important. Now, once you do your balance sheet, you've got an opportunity cost with that corn, don't you? You've got it up, you can either feed it or you can sell it. So there you may want to take and put on where the market value is. Now be careful. The last couple of years we've had a higher cost, maybe less this year. But take a look at the market cost when you do that balance sheet. But when you're using the cost, because what comes out of your checkbook again, Mike, it's what it costs you to raise that crop. So you definitely want to be using the cost of what it costs you actually to raise that corn crop.
Another question that maybe you can't answer, but what's the ROA on a beef cattle farm? Any feel on numbers on that, Gary?
Well, here that's really been difficult to come up with any kind of ROA in the last couple of years with high feed costs. In fact, right now, last year, it's been a loss of about $150 a head. So we've had a lot of 1,000-cow feedlots actually go out of business because they just haven't been able to turn any kind of return at all. But what should they get? There again, I would like to see a 6 to 8% return. 6% return on their equity and 8% on their investment. Now that's really tough to do, and that's why you see these numbers come up there. And that's when I use that 4% on the average. That's pretty much we've seen all of agriculture, that 4% return, and that's near enough. And that's why some of these feedlots have remained empty, unless people can forward contract the stock when they sell it and take a look at a forward contract of the grain. You still should be looking at least 6 to 8% on a feedlot.
Another interesting question is, what is the best way to project milk prices when doing budgeting? This listener said we use Class 3 futures and then add their typical base. Comments on that?
Yeah, they're exactly right. We can look at futures out there for over a year. And it's the future. It's what the market in Chicago is guessing where this thing is going to be based on a lot of factors. And that's a great point of adding your basis. There's some states that you don't get any basis. Here in the Midwest, we've got a lot of milk plants fighting over milk, and we can have as much of $1.50, $2. I'm seeing as much as $3 basis. And of course, with some of the color breeds, we have the better. But that listener is exactly right. That's what they should be using, because that's the best that we have to go with at this time.
Okay, put you on the spot. This listener says, what are your top 3 recommendations to improve profitability? Are there certain ratios, certain numbers? What's your top 3 to make a buck?
All right. Number 1, think about a 3-legged milk stool. The first thing you want to do is you got to be able to generate gross income. That's number 1. Take a look at where you are. Now, I know we've had this discussion of, you're kind of competing with your neighbor, but you ought to be able to take and generate that. You got to be able to take care of that dairy cow. You got to make sure she's as comfortable as possible. Secondly, what you feed her. What's the next biggest expense you've got there? Your cropping cost and when your feed cost. You've got to be able to take and get as best handle as you can on that. And there, we've heard people jokingly use the word, that's the investment. And it is. That's what you're investing in those dairy cows. So you got to be able to generate the gross income. You got to be able to take and feed that cow for a reasonable. And then you have to take a look at that labor cost of just what it costs you. How can you be more efficient with that particular dairy operation? When you take and build heifer facilities, what can you do to take and minimize that labor cost and do it the best way that you can? So those are some of the 3 areas that I would take a look at, and some of the biggest expenses and biggest income, and have the biggest factor and impact on a dairy.
Very good, Gary. Now, we had a comment. This is not a question, but someone says you're showing your age when you have a 3-legged stool. Do you want to make a comment on that or not?
Well, you got to go to some of the historical museums to see that. Unless, I'll tell you what, unless you've milked cows, and we used to do it with a universal system. You milk 2 cows at the same time, and you want to grow muscles on a teenager. Dad had me haul those double buckets to the cooler, and we had an ice bank cooler, and you lift that up and pour it into the strainer. I'll tell you what, that'll really keep you going. But that 3-legged milk stool is what you sit on, that's for sure, to take a little ease off of those knees. Let's put it that way. So yeah, and Mike, I feel very fortunate that I've been involved in this business when the average size herd, at least in the Midwest, is 30 cows. There was a farm every quarter mile, and that was really neat. A lot of families get on the bus, and there'd be 4 or 5 kids, half a dozen sometimes, getting on that bus. And that's fine. Things have changed. It's much easier, and that's called technology investment. And today, I get on dairies, you get on dairies, 10,000 cows. And it isn't the numbers, it's the profitability. So I've been very fortunate to be in this business, and I'm glad to be able to have seen that over the years.
Okay, interesting question. How could we interest dairy farmers to know their numbers?
You've got to, you're running a business. And I know I know it's a lifestyle, and we've heard this, but it is a business, and you need to understand this. If you want to have a good working relationship with your lender, it's not only impressing your lender, but it's you knowing this stuff. You've got to have that balance sheet in the back of your head all the time. And then you need to think about that cash flow. So every decision you make on that dairy, you need to think about this. What kind of a return will this get me? I'll give you an example. For every dollar you invest, you ought to be in any kind of a fixed asset or any kind of an asset on a farm, you ought to be able to generate at least $1 worth of gross income every year after that. Let's use a simple example. Let's buy a milk cow. I'll buy her, let's get a nice one for $2,000. If she generates me $5,000 in gross, I've met what I just said. She actually goes beyond that. Now, I always say this, and the tractor drivers get a little excited when I say this. Let's buy a new tractor. Am I going to be able to generate $1 every year for what I've spent on that tractor? Now, I know you got to have tractors to run the place, and you got to be efficient with those. But think about the dollars you spend on facilities and whatever you invest in. But you got to have that balance sheet in the back of your head, and every decision you make on that balance sheet and cash flow, will this add to the balance sheet? Does it add assets, or does it subtract from the liabilities on that balance sheet? Because at the end of the year, that net worth should and better be bigger than it was the previous year.
Okay, we got another question. You talked about breeding and vet costs. Any thoughts on manure management costs?
Boy, there's a matter of investing, and we see a lot of producers that actually will take and have somebody come in and custom do it. We see it all over. Now I'm seeing an awful lot of people that have drag lines because it costs an awful lot of money to take and load that manure on any kind of a tanker and haul it any distance. As far as a cost per hundredweight, I'd be honest with you, Mike, I don't have any numbers on that, where it is right now and just where it should be. But it really needs to be evaluated and just see what the best way to take and move those nutrients to the fields. So I don't have a number on a per hundredweight basis for you.
How about this one then? Was the gross income per cow including dry cows as well as milking cows you gave us?
Yeah, that's a great point, and I failed to mention that point. When I talk about cows, I'm talking about cows that are milking and dry. Hopefully that dry cow is going to be milking within the next 12 months, so we got to include her in those numbers, not only the income but also the expenses that she has to carry during that time.
When you look at another related question, when you look at the feed cost, do you always put the dry cow and the replacement heifer into that cost, or do you separate those out? And that relates back to a question on the new farm bill, where they look at the spread between feed cost and milk price.
Well, I'd love to see people enterprise, and that's why I was glad that you shared those numbers as far as the cost of raising heifers. But we don't have a lot of producers that do that pull that heifer cost out, pull that cropping cost out, pull those dry cow costs out. It would be nice if we did that to know exactly where those are. The more of those that you can enterprise and pull out, the better numbers you're going to have. So in general, these costs for raising the heifers and looking at the dry cows along with the milk cows pretty much are all bundled into the same number. But I really would encourage people to do more enterprising if they've got a dairy that enables them to do that.
Our final question, since we're just about out of time here, has with this family living costs. Should that be a round number? We see Minnesota, one of the people there suggests $50,000 for a family of four. Should it be an hourly charge? And should that vary depending if that person has got a high school degree versus a college degree or whatever?
We're talking about the owner of the farm, Mike, now?
Yes, that's correct.
Yeah. Well, I'd like Dr. David Cole's comment on that. He says, family living on a farm today is the price of a new Corvette. Now, maybe you haven't priced out a new Corvette, but I think last time I looked, it was about $75,000. Now, I know a lot of people will cringe at that, and being in the banking industry and still on a board of directors of a bank, I see a lot of cash flows. I see people spending as little as $15,000, paying themselves $15,000 a year. Now, some of the wives might cringe at that. How in the world can I make a household go? A lot of $25,000, $45,000, pretty common number out there. But you need to look at health costs. You look at all the costs, groceries and everything else out there. So Dr. Cole's number is probably pretty close. It'll run that $75,000 to $65,000. And I can tell you, on some of these larger operations, and think about yourself as a manager. I mean, we talk about, if you listen to the news, oh, CEOs are getting paid so much around this country that are running companies. Guess what? You're running a company. You're running a small business. And if that farm is generating income, and I see people taking some pretty nice incomes off of these dairies and still have a very nice looking net. So you decide what it's going to be on that dairy, but don't be afraid to pay yourself. But in order to do that, you better be able to generate the gross, and you better be able to control the expenses, and you better have a pretty decent net worth, and you better be able to have a decent bottom line.
Well, Gary, you've done the yeoman's work. Thanks for all your great answers and your rather very pointed and direct answers as well. Steve, I'll turn the program back to you to wrap up if you have any ending comments.
All right. Thanks, Mike. Again, final thanks to you, Gary, for a great job. Thanks to DuPont's Danisco Animal Nutrition for their sponsorship today. Thanks to you, Mike Hutchins, down there at the University of Illinois for your co-host duties, and also your partner down there, Jim Baltz. Well done on the part of all of you. For the listeners, be with us again, hopefully, December 9th. Joel Lauer from the University of Wisconsin, well-known extension agronomist, will be talking about growing and harvesting high-quality corn silage in the northern corn belt. Should be interesting, and we hope that you can be with us then. So thanks all for your participation. Thanks for being with us today.